Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates, and 10-year note yields remain stubbornly idle. 2 weeks ago, we got above 3% yield, and it looked like this was going to be the it moment. We were going to see yields push. We got to these multi-year highs, and then we sagged back below. Then we spent a week below 3%. And this week, we ran up there, we tested it, we got above 3%. It looked like things were going to turn, and they failed again. So right now we're sitting just at trade just below 3%. It's not like we're trading away from 3%. We're just unable to get any sustained move higher and build any momentum that will find sellers that will come in and hit this market and take it to its next level. We just aren't able to do that. And I think that right now, technically speaking, we've kind of in this comfort range. We're 290 to 3% is kind of in that range where the market feels we're warm and fuzzy. We get above 3%, we start to see the white knuckles and things then calm, and we start to see everybody kind of sigh of relief, and that's where we are right now. And if you look at market volatility in the bond market, we're seeing, obviously we're seeing it continue to trend lower, something we've talked about for a while. It's not only in the bond market, we're seeing it in other areas as well, but particularly in the bond market, when we talk about range and trading within the range of expectations, that is what we're seeing. And I think right now, in order to see a bid to market volatility outside of a geopolitical blunder somewhere overseas or here, it is going to take a move north of 3% on a sustained trade or a trade back below 275. Now, we may see a bit of volatility if we start heading towards 275 yield, which is a long ways off. But I think ultimately to see that sustained breakout trade, we need to see yields go back below 275, which means or we need to see them see a sustained trade above 3%, which I think is what many are expecting, but we just haven't been able to see it and put it together. And lastly, one of the reasons why I think we've been unable to see a sustained trade above 3% yield is, if you look at the positioning from the traders' financial futures, the leverage funds, the hedge funds, they've been slowly covering some of their shorts. They're at all-time short levels. They have been for a long time. They've been adding to shorts, and certainly that is one of the reasons why the market has been targeting 3%. But now that we're here and we've been unable to get through it over the last 2 to 3 weeks, I think they're starting to see a little bit of cover. And it doesn't mean that the market's going to ultimately reverse, but every marathon begins with one step. And I think that when you start to see the shorts, that the leverage hedge funds cover their shorts, it's a suggestion that maybe they're looking for this either market to sit here for a while, or maybe they are fearful of a reversal and they want to just cover and see where else they can make some money. So right now, those are the areas I'm looking at. I think right now the data will be all about the geopolitical risks. They got Fed speakers next week. We got retail sales. But I think ultimately the positioning could be key here. If we start to see those leverage funds continue to get out, that will be a signal that maybe the run towards 3% has run its course, and we probably will look to trade back towards 275. So bond market right now still spinning its tires as we head into the weekend. This is Todd Colvin coming to you from the floor of the CME Group.